All right. Well, we are going live. We appreciate everybody being on our webinar today. We're thrilled to have our friends from JP Morgan here to update us. As many of you recall, Monica was very popular at our E&I Summit, and so she is back by popular demand. And we are thrilled to have her and Brian here today. We'll have Brian do a little introduction of Monica, and then we'll turn the time over to Monica. If you have questions, there is a Q&A button, I believe. If you look down at the bottom, or the chat function, either one, you can provide questions that way, and we'll be happy to have Monica respond to those at the end. If they are pertinent in the middle of the presentation, then we will also have her, Brian will interrupt and let her know there's a relevant question. So hopefully you can use the Q&A function on your screen or the chat function, and that should enable us to get questions to Monica. With everything going on in the market, this is a great time for an update. So we're excited to have them. So Brian, let me turn the time over to you, and you'll do our introduction here.
Great. Well, thanks, Kelvin. My name is Brian Swenson, and I'm responsible for JP Morgan's private bank here in Utah. And we're grateful to have Monica on the line with us. Like I said, we got her in person here earlier. We're excited to have her come back once we get past all these travel restrictions and more into a normal world. But Monica she's based in New York, and she runs our Global Investment Opportunities Group, really working with sophisticated clients, thinking about how to take advantage of market opportunities. And so before that, she was basically our head of U.S. equities for JP Morgan's Global Wealth Management. So thinking about everything in the equities world, how to, from single stocks to derivatives, structures, all those different kinds of things. So she is very smart, smarter than any of us locally, which is why we're bringing her on. And we're excited to have her here. So with that, we'll have Monica just kind of walk through where we're at, where we think we're going, and then happy to take questions along the way. Thanks, Monica.
Thank you. Thanks, Brian, and thanks, Kelvin. I am coming to you today from a bunker outside of Boston, Massachusetts. Last time I saw you all was in February, right before everything got a bit crazy. And many of you I had the pleasure of speaking with after I got off stage, and gave me your own insights into what the virus could look like and what it might mean for markets, and how that we might see a bigger shutdown than people thought. And I remember leaving Utah thinking, these people they're all very nervous, and I'm sure everything's gonna be fine. And within about 3 weeks, about half of the team that I worked with in New York on our trading desk had COVID. We were sent home to quarantine, and I have not been back in New York City since. As many of you are probably aware, New York was hit pretty bad, and we have all been working from remote locations. My location is normally a bit more glamorous than this at our beach house, but I came out of the beach house for a few days. So I'm in this bunker with no windows right now. So bear with me. Hopefully the content will make up for the unattractive background. I wanted to start with just a quick update as to where we were last time I saw you all. And I was shocked when I went back and I thought about how much has happened in the last 5 months, and was wondering to myself, I wonder where the market was when I spoke to you all back in February. And if you can believe it, the market was 10% lower than where it is today, back in February. So we went through all of the craziness with the virus and the shutdown and huge impact to our economy, and yet the market is up 10%. I think most people, if they were given that fact pattern of what was about to come back in February, would not have predicted that we would have bounced back so quickly. So what I want to talk about a little bit, because the biggest question I get today is, is this sustainable? Can we keep going at this pace? Or given how tough the outlook is from an economic standpoint and potential future shutdowns related to the virus, is this just a temporary thing and then you see things turn back lower? And the analogy that I hear most often is one around 2008 and the financial crisis. And for those of you who remembered, and I remember quite acutely because I worked at Bear Stearns, we started 2008. Bear Stearns went under earlier that year, was acquired by JP Morgan, and the market actually rallied quite a bit after that. And it wasn't until Lehman Brothers fell in the fall, and you really saw the underbelly, if you will, of what was going on in the real estate sector and in other sectors, and it finally dragged the economy into recession. And so if you think about the market, I always think in a bull and bear case. The bull case is the market's right. It appreciates that the virus is a temporary issue. We're going to move past it eventually. And so the market is forward looking. And that's why it's up 10% from February. The bear case would be, this is 2008 all over again, in that we're seeing this drift higher, but we haven't really fully appreciated the impact of historic levels of unemployment and bloated GDP and what that could look like over the next couple of years. And therefore we might drift lower again. Those are the two competing themes. I get these questions every single day. One other thing I used to talk about a lot last time I saw you in my old life was the upcoming election. And I'll hit on that a little bit because I almost never get asked about it now, which I think is fascinating because normally in an election year, the market basically revolves around the potential change from a policy standpoint about who might be the president, if the Senate will flip, et cetera. And it just doesn't feel like people are focused on that right now. Again, rightly because they're worried about their own health and what's going on in their own cities and towns. But as we look towards later this year, this is going to become a major part of how the market's going to move and really impacts all of us because when you think about things that have come back very strongly since the virus first started, like the IPO market, which has been very hot for both the tech and the biotech sector, any sort of instability around the election could put a pause on that. And I mentioned that because I know I saw you guys right after our healthcare conference back in January. I was just meeting with our team of investment bankers covering that space. And they said the pipeline for companies coming public in both tech and biotech is as robust as they've seen in the past 10 years. So in spite of all this noise and all the volatility, you have a market near record highs, you have an IPO pipeline that looks extremely hot. These are generally things we see in a bull market. So I want to turn a little bit, and I have a ton of slides here and I apologize. I know more is not always more, but I did want to hit on a few things. I'll move through them fairly quickly, but please feel free to use the Q&A button, ask me questions or save it for the end, whatever you guys feel comfortable with. We've structured these into a basic format, which is kind of where were we in this economic cycle and expansion? What have policymakers done to keep it there? What is our outlook? And then what are some big question marks that we all should have in mind? So, this first slide here, which talks about the shock from COVID in the manufacturing sector, what we're just trying to do here is put in context from a historical perspective, what the shock from this virus looked like. So basically, where were we from an expansionary standpoint and how severe was it? And as you can see, I just made that parallel to 2008. The impact of COVID on both our economy and global economies was as significant as the 2008 crisis. So that's really the backdrop that we're working with. The impact to shutting down manufacturing, people being out of work, demand collapsing because people were forced to stay home had the same impact as the Great Recession that we saw just a little over 10 years ago. And this is important because as you can see, we've bounced back a little bit from lows from a manufacturing and economic standpoint. But again, recall where I started. The stock market has already bounced back and is basically at levels it was before all this started. So the market tends to be forward-looking and indicators like this, like PMIs, tend to be a little bit lagging often what the market does. So the question mark will be over the coming months, will we see this line here keep moving higher? Will you still see economies growing and kind of getting over that 50 level, which is the important level to think about from an expansionary standpoint? I'll jump ahead from here. So we'll just move a bit quickly, just in the interest of time. On the next slide, slide 2, what you're going to see here, this is just like a basic bubble chart. What we're trying to show is how we think about this recession. We think about where we were from a cycle standpoint. So we transitioned from late cycle, which is where we thought we were about 6 months ago, into a full contraction. And as you can see here, you can see the size of the bubble that shows the percent from peak to trough. And if you go back, the biggest bubble there was obviously back during the Great Crisis, the Great Depression rather, in the 30s. You saw we had a pretty big pullback. Then you can see what happened here back in 2020. And as we start to move forward, we saw a pretty drastic, sharp move downward, and then a move back up that snapped up pretty quickly. The big question we always get all the time from clients is, will it be a V-shaped recovery, a quick snapback, or more like a U? We still think it's probably a U-shaped recovery where it's going to take the economy a bit of time to come back, even though the stock market has pulled back ahead of us. So again, when we think about the outlook from here, this slide is important because it just helps you keep in context how big the declines are, how fast we tend to bounce back. And what I would just say is, while the bounce back was pretty quick, from an economic standpoint, what we all feel on the ground, it's just going to take a little bit longer for things to feel normal. On the next slide, we talk a little bit about how this is affecting people individually. The unemployment rate, you can see just how high the unemployment rate became from the COVID situation. And this is relevant because the US is a consumer-driven economy. If people aren't working, they don't have money to spend, there's actually no way for us to have growth without a strong consumer. And vice versa. I think when I saw you guys, I probably mentioned there's no way to have a recession if you don't have a consumer recession in the US. And so right now with unemployment rate near these highs, even though we've bounced lower, this is going to be a big part of what the next 6 to 12 to 18 months look like. You're going to need to see unemployment come back down. I would probably argue towards the high single digits for there to be really any longevity to the rally that we've seen in markets. Because again, if people can't get comfortable spending around holidays, starting to think about vacations as they go into next year, there's just no way for the US economy to keep expanding beyond the quick snap we've already seen. We'll talk about this a little bit later when we get into the election, but the other big thing to keep in mind is, will the government pass more stimulus to put more money into people's pockets? And of course, that's being debated right now. We're hoping to see some resolution in the coming few weeks. I think if you were to see an end to the extended unemployment benefits and things like that, that would be a pretty big negative for the outlook from here. Let me move quickly through just the rest of the expansion slides. I might just skip the next one and just move into the retail sales slide, because again, I think this is an important one to consider. Yeah, that's number 5. Thanks, Brian. So what we're showing here is how much retail sales collapsed. And again, we compare it to the 08 and 09 cycle there on the left. And you can see, again, very similar kind of contraction. Again, in consumer spending and things like that back in 08 and 09 and back in this last few months here. Now, we've already snapped back pretty quickly. We're actually seeing some positive retail sales numbers again. But of course, the big change now versus back in 09 is the chart on the right, which is household debt is drastically lower right now than it was back in 2008 and 2009. And that's a big deal because when you think about people not paying their bills or not paying their rent or things like that, if you actually have a bit of credit and you can stretch a little bit, you probably can keep spending even if you are out of work for 3-6 months. This is why the back half of the year and whether the government keeps stimulating through the unemployment benefits is a big deal, because if they can figure out a way to keep people spending and keep them paying their rent and living somewhat of a normal life, even in quarantine like me, you're going to see a more modest impact to the economy. And the way that I would sum these last few slides up is the big debate right now is this impact from the virus akin to a snowstorm or like, a hurricane or something like that, where you have this very strong hit, a big blip to the economy, and then things bounce back? Or is it more akin to a full-on recession, which often takes 12, 18, 24 months to come out of? And we don't have a great answer now. I do take comfort seeing that retail sales bounce back, because it does tell me there's pent-up demand and people still feel comfortable going out and spending. But I'd like to see them stay that way for a couple months before we're ready to make a call and say that we're totally out of the woods. So I truly believe the next few months are going to be probably the most important in figuring out whether this is a blip for 2020 or whether we can actually see a continued bounce back into 2021. The last slide I do want to hit on is just the next one, because the credit card data spending slide, number 6, we're obviously JP Morgan, we have a ton of access to what people spend on the Chase side, on their credit cards. And it's been really amazing to see, again, how quickly spending has bounced back from where it was back in March. You can see this big nosedive right at the beginning, and then very quickly spending coming back all over the place, broad spending, almost back to positive territory again after it sold off earlier in the year. Really interesting though, even restaurant spending meaningfully bounced back. And a lot of that obviously is takeout, but you're starting to see some restaurants start to open up again. And again, we'd want to look at this data through July and August to make sure it gets back above 0. But to me, that's how I get comfortable thinking that the US consumer and probably our economy are much more resilient than a lot of people expected. I want to pause there because I don't want to go too far into some of the weeds here. If there are any questions or anyone wants to jump in with anything. Any questions in the group for anyone?
If you have questions,
otherwise I will.
If they have questions, they need to do it through the Q&A because everybody's muted. We don't want to have a free-for-all. So through the function or through the Q&A, you can ask questions. And Brian, if you monitor that.
Yeah, Brian, if you don't see anything, I'll keep going.
I don't see any right now.
Okay, great. So just the last one, I think that's, the last one that I want to hit on is slide 8, Brian, which again, to sort of sum up where we are from a health and where we are from the standpoint of this expansion. Slide 8 shows how we think about corporate debt. Because I talked about how US households don't have too much debt and are looking pretty healthy. And I think it's also important to say, okay, but what about companies? Because as important as households are, you do want to think about whether corporations are equally as healthy. And what's pretty important here, you can see again, the shaded areas are times of recession. So normally you would see debt pick up into those. And we have seen a pickup, broadly speaking, but we haven't seen, again, all the normal things we would expect, which would be big spikes in household debt, huge spikes in corporate debt, huge spikes when you think about mortgage debt, things like that. So I get, oh, sorry, I'm realizing the slide and the screens are the same one that I'm talking about. It's my slide 8, Brian. It's the one that's titled Non-Financial Corporate Debt Levels Are Elevated. Yeah, that one. So the big takeaway here, I know there's a lot of lines. Shaded areas are the recessions. Lines just show how normally debt spikes in recessions. We're seeing some modest increase in this one, but again, from historical levels, not as high across the board as we have seen before. So the big takeaway and the final point I want to make here about where we are from an economic cycle is, you know, we have a consumer that seems to be pretty resilient. They're bouncing back. They're spending. They don't have too much debt. Corporations also feel like they're in pretty good territory, benefiting still from the tax cuts of a couple of years ago, as well as relatively low debt loads as well. And I think the last point you want to keep in mind, which will dovetail into the next section, is you can't ignore the fact that interest rates are basically near zero. And so it's very cheap if you need to borrow money, if you need to, you know, push out some liabilities. It's also very cheap to service any debt that companies or individuals have. And so as long as rates remain low, you know, we actually think that you could see us come out of this faster than in a quote normal rate environment where rates are at 3%, 4%, 5%, just because it is so cheap to just push out your obligations and manage one's balance sheet. So that's really the end of the area where I want to talk about where we are. I do think what's important to highlight now before we get into sort of the outlook and the few things we want to keep in mind when we think about the outlook is the impact of how much monetary policy and fiscal stimulus from the government and other places has been. And probably the best way to do this is slide 11 on my end, where it says there's been a coordinated monetary response. I think it's 2 or 3 ahead, Brian.
Monica, while we're going there, we just have one question on, do we have any data on construction and, you know, its meaning there?
I like, as far as like building, like I'm assuming you mean as far as like home building or residential construction, things like that. We do, I don't think I have it in here, but we can follow up and I can circle back through Kelvin to share it with you guys. You know, it's actually been shocking. Anecdotal data from companies that we work with is that housing and everything actually feels fairly strong, but it's going to depend on which pocket you're looking at. Again, residential areas outside of urban areas strong. Where we've seen a bit of an impact, as you can imagine, in urban areas, where we're seeing people rethink big projects. So think big high rises, things like that. We have seen some spending come down, but I can get that to you guys from a historical standpoint. And that's gonna, you know, we'll talk about this a little bit later. We talk about parts of the market and how they performed. But I think that hits on a very important point, which is while the market has bounced back and the stock market has bounced back, it has not been the same for everybody. And we'll get to it later, but you'll see there are certain sectors and certain companies that have been able to take advantage of this and really expand their footprint, while other sectors and others have really underperformed in spite of the fact that the overall market is up. And one area that we do think will underperform going forward are some urban areas where there's been a lot of rethinking about, you know, I'll use JP Morgan as an example. We're building a new headquarters. Right now we have 6 offices around Midtown Manhattan. They want to consolidate most people into one office. Given everything that's happened, there's no going back, we're building the building, but you do wonder if other companies will rethink plans like that going forward, because there probably is value to having your people spread out to a certain degree in situations like what's going on right now. We walked through kind of where we are, where we were before everything happened. The biggest takeaway in this section that I want to hit on is it's hard to quantify sometimes. People say this, and I think this chart actually illustrates it pretty well, which is how much have central banks really stepped in to save the day. So think the Fed here, the European Central Bank, the Bank of Japan. And they did by doing a coordinated effort to stimulate and put liquidity into the economy. And if you go back to March, when markets were moving 5–10% a day, which was completely crazy, what you had was the Fed step up and say, you know what, we're not going to allow bad liquidity conditions to drag this market down into a broad recession. You saw the Fed step up what they were willing to buy and say they're willing to go out in the market, they're willing to buy high yield bonds, they're willing to buy more than just treasuries to help provide the liquidity the market needs. And you see on this chart, just the massive amount, this is billions of dollars, by the way, that had been stimulated all around the world from a variety of central banks. If you look at this, you should be a little bit nervous because you're thinking, how long can this go on? Is this sustainable for 3, 4, 5 years? We don't think it is. You can see we have projected there that the stimulus will die down by the time we get to 2022. But look at that, even in 2022, it's almost at the highs where we were historical times. So trying to make sense of what's happened in the market and how quickly it's bounced back, you cannot ignore the impact that just funneling money into the economy from the Fed and other places has had. And I suspect that as long as they're there to provide a backstop to the economy like they were back in March, you're unlikely to see any sort of correction as severe as what we saw in March, because the Fed is stepping in and they're buying assets from the market. And this is important because you can't predict what might happen for the future if you don't understand how supportive they are going to be. So now we have this backdrop of questionable economy with some shakiness to it, but a good, pretty good consumer, pretty good corporate balance sheets. And now you have the Fed basically saying, we're going to do whatever it takes to keep things going. And that is a big deal. And if you move to the next slide, what that means, what we think things are going to look like going forward is pretty low interest rates for the foreseeable future. And I get this question all the time. When will rates go back up? What will they look like? We don't think over the next 2 years, you're going to see a meaningful move higher in interest rates. So again, great for stocks. If you own stocks, equities tend to perform very well in a low interest rate environment, because again, there's nowhere else to go if you want to try to get an interesting or attractive return. Less interesting if you own a large portfolio of treasuries or munis or other things like that, because you're not earning as much as you used to. Very interesting for anyone who might want to refinance their mortgage or is looking to borrow money. And again, we think this is going to be really what the outlook is over the next couple of years. I would assume, rates under 1% for probably the next 3 or 4 years, if not longer. One other point we just wanted to make here, which I think is important, is 2 slides ahead, the facility usage slide. And I don't want to go down too far of a rabbit hole here because, well, it all gets a little bit convoluted, but what's important to highlight here is how I showed you a few slides ago how much the Fed has injected and others into the economy. This just highlights how much more they have left. And there's a lot of room to go before they run out of some levers in certain parts of the economy and liquidity actions they can take. So you should all feel pretty comfortable that, again, we can debate long-term what this sort of stimulus will do to an economy and inflation and what our economy might look like in 10 or 20 years. But this means the path for the next couple of years still looks pretty clear, where you're going to have a very strong Fed that's supporting the US market as it tries to recover from whatever the longer term outcome is from this virus.
So Monica, one question we've got around that. So with so much money being pumped in, how can inflation stay low? And do we think that will happen soon, or when do we think that's going to happen? And I'll add on one other piece. Are there any other kind of follow-on impacts to that we should be thinking about?
Yeah, why don't we jump a couple slides ahead, because there's a chart about the US dollar, which I think is interesting and hits on exactly that point, which is, what you've seen is you see very low interest rates here, and the US dollar remain very strong. And the big question I get, if you still have this Fed keep spending and the government keeps stimulating, but we don't find any way to actually pay down our debt. At what point is it just a tipping point for the US and we just can't continue to pay our bills? There's two things you need to think about here. One is, actually, back up before I go into that, let me just mention inflation. Broad inflation across the US economy is very low, but make no mistake that there are parts of the economy where we're seeing meaningful inflation. And the reason you don't see it in the headline number is because of the way technology has changed efficiencies and things get done here, whether it's robots and manufacturing, et cetera, mean that we've just become more efficient. And as a result, you don't see the broad headline inflation like you might have seen in prior times, in prior similar times. My point on the US though, and where I worry, and I think we all should worry longer term, is at some point the music stops, right? We're gonna have to pay back some of this debt, or rates are going to go higher and it's going to be more challenging for us to pay back the debt. And what does that look like? It remains the view of our economists, and this isn't a great answer, but it is our view, that that scenario is 20 plus years away. Doesn't mean we shouldn't worry about it, doesn't mean our kids shouldn't worry about it. It probably just means for most of us who are investing day to day and month and year to year, it's just not going to matter for a long time. And the reason is pretty simple. There's no other market that is as liquid and deep, I talked about this back in February, as the US, and that still remains. And so if you are a global investor, and this is why the US market has bounced back so much quicker than some others, and you need to put money to work, you're still coming to the US because we have clear financial systems, better laws, better recourse if something goes wrong. And as a result, you've seen the US dollar remain quite strong. My view is over the next 5 years, you actually do see the dollar weaken and things moderate a bit because of the results of all this debt and all the stimulus. But I don't think it's a near-term issue that should cause anyone concern when they're thinking about investing over the near term to medium term. I saw a couple other questions pop up. I don't know if there's anything else we want to hit on now before we jump into the outlook part.
Yes, there's one that I'll wait till the end. Another one just came in. Have we done any sensitivity analysis just around COVID continues to expand and what that might mean, I'm assuming for like a second shutdown or?
Yeah, so I have a slide about that later, but I think we should jump to that, because what I was trying to do is talk a little bit about, kind of where we were from an economic standpoint, how policymakers have helped us pretty much stay afloat from where we are to where we are today. The next section with a few slides, there's a lot about earnings and valuation. I don't want to go into too much detail about valuation. I think what you should take away here is if you believe, and we're going to talk about the big question marks, COVID and the election in a minute, if you believe that growth picks up again in 2021, then there's upside to equities. If you don't think that happens, that we actually see growth moderate or even decline in 21, then stocks should go down. And that is really the crux of what we're going to talk about in the valuation section. Let's jump though, my slide 29, the spread of COVID and its containment are key for the investment outlook.
Monica, we're going there. I guess there was one follow-up question on the dollar. So with dollar liquidity high and interest rates low, how can the dollar stay strong for any length of time? It's kind of the follow-up question before you jump into the COVID stuff.
Yeah, I mean, logic would tell you with rates so low, why would anyone be funneling money into the US? Shouldn't they go elsewhere? Well, the problem is there's really not anywhere. I mean, rates are so low here, but they're negative in Europe. They're negative in other developed markets. And so if you're trying to find a large developed market to put money to work in, the US is still relatively better and relatively safer than many of those other markets. And it's still viewed as sort of the standard currency. Now, if some emerging market could get anywhere near the liquidity the US has and offer the attractive rates they offer, that might be a competitor to us someday. The view is always that at some point China kind of takes over as the reserve currency and the place where people want to invest, and that would give competition to the US dollar. That still hasn't happened. And in fact, if you look at some of the concerns, some of the questions after obviously this virus outbreak and how China has handled it and partnered with others, it has a lot more people still very concerned about whether their financial markets are in a position to be truly competitive to the US from a transparency standpoint. So, again, it's not the great answer, because it's sort of like saying we're just the best there is at the moment. But unfortunately, that is the reality. And until something changes, where you find a deep enough financial market to compete with the US, there's nowhere else to go if you're a money manager with billions and trillions of dollars to put to work. You just don't have any choice. And so you end up investing in the US, and that helps to position our dollar where it is today. But I do think over the next 5 to 10 years, you do see that moderate.
And with China pushing the yuan, renminbi, all their currency, how long do you think that takes? And do you think that's in the near term that we actually see that posing a risk to the dollar? Or do you think that's longer term?
I will tell you, if you had asked me this a few years ago, I would have given you a similar answer and said, hey, I think in 5 years, you'll see China be a bigger competitor to the dollar when it comes to bond investing and other things. And they have actually opened up their market quite a bit, where US and other investors can actually buy bonds and invest in a more transparent way. But the key there is a more transparent way. It's still nowhere near as clear as it is in the US. You still have a questionable judicial system if you try to go after a company as a bondholder. And so as long as that's the case, it's just going to remain that people are going to demand higher returns for those kind of assets. And they're just not going to be a core part of substantial large portfolios long term. So 3 years ago, I would have said in 5 years, China looks like a bigger player. Now 3 years later, I'm saying, yeah, in 5 years. So my guess is it's going to take longer than anyone thought, because unfortunately they haven't been able to open their markets up successfully as much as some of us, including myself, thought they would have. So my slide at 26, we start to go into some of the COVID slides, and there's a lot here, and I don't want to harp too much on there's some slides about restaurants, how many people are sitting in restaurants and things like that. But I do think there's a couple slides at the beginning. I'll just let Brian get there. The first one, the title I think says it all: the spread of COVID and its containment are key for the investment outlook. And yeah, that's the one right there, Brian. Basically what we're showing here are cumulative cases, but I think, the most important question is, what does this look like, again, in 2 or 3 months? And do we have another sharp increase in the US or another sharp increase in any other of the developed markets? Because there's no way to think that earnings can stay on track into 2021 in a scenario where we have a lockdown again. And so in our opinion, the modest, rollbacks like we've seen in the South right now, like closing gyms, closing some restaurants, some businesses again, not a big deal. We think though, if in the next few months, you see a more sustained rollback, almost like back what New York was like back in March and April, if you see any of the big states in the South go to a full lockdown, we think that that's going to be severe enough to cause a more substantial shock to both the US economy and to the stock market again. And I'll roll forward, the next slide. You can see there's concerning hotspots in the US. What they seem to be aiming for right now is more of the course correction, more than a full-on lockdown. But again, we look at places like Arizona and Texas, still think those, as well as Florida, look pretty worrying right now, just because of the number of tests that are coming back positive. And as a result, you do wonder if at some point the governors there capitulate and actually do a more significant shutdown. I think that would be the scenario that causes what I mentioned earlier, that 2008 kind of issue where you had the market bounce back quickly like we've seen, and then you see another correction. Now, remember what I said about how the Fed stepped in and how quickly they came and how much liquidity they gave? That's why if this happens and this orange line keeps going higher and some of these states keep running and maybe the states that have come down start to go back up the curve again, I think the drawdown or correction that you'll see is more in the 20 to 30% range than the 40 to 50% like we saw back in March. And again, the reason is just because you have that support from the federal government and the Fed itself, which stepped in very quickly. And I think the assumption from market participants will be that they will do that again. Even though, again, it'll be painful to have that correction, I think they're going to see a lot more money pour out very quickly to try to stimulate in the states that are forced to shut down and to help consumers weather, another few months so that the virus can moderate. There were a couple other slides that I thought were worth hitting. Yeah, I'm 2 ahead because I've been talking a lot about the US and US numbers. I do think it's important to mention, how quickly China was able to bounce back from this. And as you can see, they're, seeing activity, spending, things like that start to come back, where we could actually see positive numbers on this chart as quickly as over the next few months. And I talked about how you've seen different pockets of the economy do better or worse. If you were to look at some of the Chinese consumer stocks, Chinese gaming stocks, some of the retailers that sell goods online in China, they have bounced back and are almost back to pre-crisis levels, which is amazing. Because I think if you had asked people a few months ago, would you be going into a casino anytime soon? Most of us in this call probably would have said, heck no. But yet in China, now that we've seen Macau open and other areas open, they are seeing significant spending and traffic again. And so as long as, again, they can keep their virus count and spread at a manageable level, you've seen a very meaningful bounce back. And this could be a playbook for how we think about the US in the coming months, if we can continue to keep the numbers in the South at a palatable level, where you could see demand, call it by the end of the year, start to be pretty attractive again in certain parts of the US economy. I think there were just one or two other slides I was going to hit on. Well, then the next slide goes into the other big wild card, which is coming, which is obviously the election. So when I saw you guys back in February, the view from us, as well as the view really from anyone who likes to make bets on elections, was a Trump win. Probably the Democrats kept the House, and that the Senate probably stays in Republican favor. So kind of the status quo. That at the time I saw you in February, 70% odds were where we were then was going to be where we are come the following year. That has completely flipped now. We are now at 65% odds of a quote blue wave, where we see Biden win, Democrats hold the House, and Democrats flip the Senate. The market is anticipating that that is the outcome. Now, I believe if this had been the view a few months ago, you would have seen the market start to trade down once this became consensus view. Because generally speaking, people were worried about a Biden or very progressive administration, because what does it mean for, healthcare? What does it mean for tax cuts? What does it mean for things like that? Now that we've had to go through everything with this virus, the view is, and why the market hasn't sold, is that even if you do see this blue wave and the Senate flips and Biden wins, it's unlikely that he's going to pursue some of the most draconian things that would hurt the market and drag down growth, namely rolling back all of the corporate tax cuts. And the view is on our side that he just realizes that would just be probably not palatable from an economic standpoint at a time when the economy is on shaky ground, to roll back all those cuts and sort of, make changes that would leave companies potentially looking for other places to go higher and to grow. And so while he might roll back some of the personal tax cuts, we looked back historically, and generally speaking, if you raise taxes on the top 5-10% of the US economy, lower it below, you're just essentially transferring wealth from one part of the economy to another. That doesn't tend to actually have much of a market impact. It's when you tax meaningfully corporations, where you see it flow through to earnings and spending and hiring, that has a bigger drag on the economy. So we think it's most likely in the blue wave scenario that any tax changes are more on the personal side, which is unlikely to weigh on the market, which is how we still have a constructive view in spite of the fact that the market's now leaning towards, again, I'm putting my personal politics aside, leaning towards a blue wave, which would normally be pretty severe, I would say, for a market reaction, but we don't think that's actually going to be the case this time. We have a few more slides in there that I think are worth hitting on. There's a few slides up where we talk about COVID hasn't changed the trend in increasing concentration in the S&P, it's amplified it. It's my 34, Brian, I think it's the next one. Yeah. So this is interesting, and this trend was well in place when I last saw you guys, which is the strength of some of the FANG stocks, like the Amazon, Microsoft, Google, et cetera. And if you look at the chart on the right, what you're going to see, which I think is very interesting, is if you split out the FANGs versus the S&P. And you can see, yes, the S&P basically in that gray area sold off back in March and has basically bounced back, as I said at the beginning. But look at how much the tech stocks have outperformed. So they sold off, cratered really, and then are meaningfully higher than they were back in February and March, which just shows you again, like the haves and the have-nots under the belly of our economy in the US, which are companies that are thriving obviously in this environment, like an Amazon, like a Google, because people are spending more time online, doing more shopping there, having things more delivered to them. While on the flip side, you can look at the parts of the economy that have struggled, like retail, like airlines, like cruise lines, leisure companies, things like that. Those have been the near-term losers at the expense of these tech stocks. And I get asked every day, can you still own these? Should you still buy them? I think if you don't own some already, it's always tough to chase them at these levels. But I personally own many of them, and I probably will still for some period of time because, again, I think they're going to keep consolidating, consumer demand, and I don't see any changes in behavior in the way we're spending in the near term, or the way we're, consuming media, buying things online, et cetera, et cetera. So I want to pause. I think I might have saw a couple more questions pop up. That was it for my broad slides, which I know were quite broad and hitting a lot of topics. But I will just say in conclusion, and I'm going to keep answering questions, of course, it's been a crazy 6 months. And I think it would have been hard for anyone when I last saw you guys to predict this would happen. But I do think how quickly the market has bounced back is really a sign of the resiliency of our consumer and our economy, and how quick the government and the Fed were to respond. Doesn't mean we're out of the woods. When I think of the next few months, I see two big things, again, that could cause some consternation. If the virus gets much worse and we see a meaningful part of the South shut down, watch out. I think we'll see a more meaningful pullback, call it 20% plus over the next few months. And then I think if you were to see a Biden administration come in and meaningfully announce corporate tax changes, that could be another reason for the market to sell off again. And I would put that at a 10 to 15% kind of pullback. Absent those two, I think we probably end the year higher than we are now, which is pretty amazing considering everything we've gone through.
Great. So a few questions. One, someone just asked if you could explain what is meant by when you say consolidating consumer demand.
Sorry, when did I say? I said consolidating demand into certain sectors. So if you think about it, 6 months ago when I could go shopping and I'd go walk around, right? As a consumer, if I had $100 to spend, I might spend some in a restaurant. I might spend some, at a bar. I might spend some of the weekend shopping in a store, going to a spa. In a world where people feel less comfortable going out, less comfortable traveling, like demand and where people are consuming, their goods for everyday life have been consolidated to fewer places, tend to be closer to where they live, and also tend to be more online versus like brick and mortar. So it's already it's basically exacerbating a trend that we already saw coming, which was less, shopping at corner stores and, at malls and stuff like that, and much more moving online, which is why you've seen some of these tech companies just meaningfully outperform the rest of the economy. And I think the question is, once everything opens up again, do we all go back to our old behavior? Or is any of that permanently impaired, where we just say, you know what, like a good example I would use are gyms. If you guys have followed the stock of Peloton, it's been on a complete tear, right? People wanted bikes, they want their treadmills in their house instead of having to go to a gym. So the question will be, when this is all said and done, will people still want to work out in their homes, or will they want to go to gyms? My guess is people will want the social aspect of working out outside, but I don't know that, I do believe that part of the experience of being in a gym has probably been permanently impaired, and that you're going to see some of the stronger companies survive, and some of the smaller and weaker ones, unfortunately, probably won't.
Another question, the fact that gold continues to scale new heights suggests fear is taking root, but the market continues higher too. So how so? Yeah,
they won't all continue the same direction forever. So that has been, for me, one of the strangest things to watch over the last few months, because normally you'd be adding to gold in times where you're nervous or where you're worried about big changes, inflation, deflation, et cetera. And yet here we are with the market bouncing back so quickly, and gold and silver as well at all-time highs. And silver is kind of like a higher volatility way to express a view on gold. My view is, and I've been having clients add to gold positions actually over the last couple months, and someone called me before I got on this call asking if they should keep adding, and then we ended up adding to their position. My view is, longer term, I believe that it makes sense to have some allocation to gold in a world where rates are very low. And so I think part of the reason that you've seen gold move like this and equities move like this are a function of very low rates. Because gold, if you normally own it, it doesn't yield you anything. So in a time when rates are modest or high, it's really a drag on your portfolio to own gold, because you get no income for that asset that you've purchased. You just have the gold and you're sitting on it. But in a time when rates are very low, suddenly the opportunity cost of owning gold becomes more compelling. And so you actually see people shift towards it, which is what we're seeing globally right now. And so we're in this funny period where equities are going higher and gold is going higher because of rates. So I think the question is, where were we a few years ago from a gold allocation standpoint? We were at like the lowest levels we've ever seen historically. So I think part of what you've seen in gold is a catch up. Again, my equity view is we end the year a little bit higher than this, but as we go into next year, you're still talking about a slow grind to come out of what's happened to both the US and global economy this year. So I personally still like having gold in portfolios because I struggle to see a world where equities are up, next year more than, call it 7-8%. And so in that world, where best case, I think equities are up 7 to 8, worst case, it could be flat to down. I still like owning gold because I think it's a good balance for a portfolio, especially in a time when rates are low.
So we have two more questions. One of them was along gold, but also other non-petroleum natural resources, if there's anything they like as a hedge. But this is also, I think this other question kind of coincides, given the near-term uncertainties in equity markets and low interest rates, what recommendations do we have for alternative, hedge investments? So maybe those kind of go hand in hand.
Yeah, so as I mentioned, we've been using gold a lot as, I hate to say the word hedge, but I do think it's about balance, right? Because gold is just going to, generally speaking, move differently than stocks in a portfolio. And so we've been using it as a balance, as a way to take advantage of low rates. When I think about hedges, I like to hedge the pure market and the pure exposure that you have, because I just think it's the most direct way to basically balance out your risk. So for me, I own a fair amount of stocks. I do look at hedges from time to time. It's an interesting time right now because the market has rallied, volatility has come down meaningfully. And so you can actually buy hedges much cheaper today than you could have a few months ago. And the way that we're doing it is to buy a put spread, which is you buy basically exposure within a band. The latest one I looked at was about 2,900 on the S&P to 2,500. So in that band, you're making money if the market sells off below 2,900. And the way we funded that was by selling away upside. So I was selling away my upside on the S&P over 3,450. And that was for about 6 months. And so we've been doing sort of tactical trades like that for people. That trade costs nothing to put on. And that's I think an interesting way to just have a hedge on for that scenario I outlined where the virus gets a little worse. Maybe there's some policy stumbles and you do see that 20% kind of correction. That hedge would protect you well. And it's inexpensive to have on. And if we're wrong and the market just keeps going higher and runs above 3,450, I just size it correctly so that if the market's at 3,600, well, I lost a little bit on the hedge, I'm making more on the rest of my portfolio.
Do we have what's our estimate for the range for the S&P at the year end is another question that came.
Yeah, our team is still looking for 34 to 3,500 on the S&P. So not that far away from where we are now, but I personally think 3,500 is pretty bullish. Like, I think that's the scenario where we somehow get a vaccine, call it late fall. You don't see the southern states shut down again. And again, you don't see any significant corporate tax policy coming out of a new administration. I think you would need all of those to happen to kind of get that 3,500 plus level.
And then one along with that, where do we see GDP for 2020?
Ooh, nasty. But, we're still calling for mid to high single digit GDP declines in Q3 and Q4. So again, I would separate that from what our market expectation is, because of course the market's looking ahead. The market's saying, yeah, I know 2020 is a nightmare and earnings are down and growth looks terrible, but they're looking ahead to 2021 and 2022. And we actually do expect that you can see positive GDP in 2021. And that's what's going to be most important to whether the market can stay here and go higher or whether it drifts any lower.
All right. One other question is, companies move supply chains out of China. What impact do we see happening to the US and to China?
I had a slide in there about will you see that the trade wars, pick up again? Again, in a world, and two scenarios, right? If Trump wins again, a lot of people believe the trade war was a way of him trying to, posture a bit and make it seem like being tough on China, even though I believe we probably do need to be more tough on them with patents and things like that. So in a world where the Trump administration wins again I don't know that they have the impetus to start any more meaningful trade war. And the question is, under a Biden administration, do they pick up where Trump left off on any of these, questions about pushing back on China and being tough on tariffs? We don't see that happening very likely either. So will the companies that maybe don't want to manufacture in China anymore all come back to the US? We unfortunately don't think that's very likely. More likely they would go to other lower cost places of production, whether it's other parts of Southeast Asia or Latin America, before we see any meaningful flow, unfortunately, from a manufacturing standpoint back into the US. I do think, though, this concern, again, and the tensions and escalating worries about China will be something that we need to think about in the backdrop over the next few years, because, of course, China is such a big part of, you think about the growing consumer there, and what's consumed from our country and other countries around the world. If you follow the European luxury brands, for example, not being able to have Chinese tourists travel around Europe and shop and spend money has been a huge drag on really the European Union as a whole. And so, when I look for the next few years, you'd hope that we could come to some more harmonious stance where you can see travel open up again and people start to, exchange goods and services more freely across the borders between the US and China. But that's really a question mark from a policy standpoint as to how the new administration or the existing administration, if they win, choose to move forward. It concerns me that you could see some sort of prolonged, trade war rhetoric like that. That is definitely would be a negative to both the US and I would say the global economy.
So a follow-on question that is, what's our outlook on India as an alternative to China as supply chains move around?
Unfortunately, we don't think India has the capacity to take on everything that China was doing and was manufacturing, but they certainly could be one outpost. And so you could imagine that they would soak up some of the demand that might come if you have more people move out of China. But unfortunately, at this point, it's not built up enough from an infrastructure standpoint to take on everything that China was doing. Now, they are also being very aggressive in trying to move themselves and the country forward and become more of a global player. And I think you'll see them keep going in that direction. The challenge for me as an investor is it's just really hard to invest into the Indian economy. You can trade the currency. There are a handful of stocks. And we do work with a few managers that have done some private investments in India, which are pretty interesting, but it's still a very nascent economy, not very open markets. And so really difficult, especially for a US investor, to do much there.
Right. So follow on to that, are there other Southeast Asian countries that would benefit more from some of the supply chain?
Yeah, I mean, many have looked at really anything outside of China, right? So you look at the Indonesias, Taiwans, et cetera, perhaps. I still think there's probably more that could be done around Latin America. When you think about everything that's been going on in Mexico and other Latin American countries, that they could probably pick up some of that. And then I think longer term, the question is, does any of it come back to the US? And again, we're just not factoring in a meaningful amount actually coming back into the US. When we think about other Southeast Asian countries, we don't, I'm trying to think of where we've added exposure. We've dabbled a little bit in Indonesia and Thailand, and that's more just been on speculative trading as China starts to reopen up and you start to see people start to travel again and goods and services flow across borders. But the other challenge with those is, again, these are just relatively small economies and relatively small markets compared to China. And so as much as you would love to think that we could source everything elsewhere all around Southeast Asia, it still remains very difficult to take on everything that China has been doing for so many years now.
Makes sense. All right, we've got one other question here. Because I see the BioUtah logo over Kelvin's head, what's your view comparing returns on US biopharma versus China biopharma over the next 5 years?
Ooh. Well, Kelvin didn't tell me to say this, but I am much more bullish on the US side. And that's mainly just because of I should say US and European. And I think you've seen a lot of interesting European companies and partner with those in the US as well. Not to say that the Chinese companies aren't doing a lot, but when I think about the amount of spending in innovation, and again, I look at a lot of the companies that are coming public and what they're working on, it's just been staggering. And so I am more bullish there than I really personally can be in China, because I just don't have the visibility into what some of the Chinese companies are doing to get us comfortable. I expect if you fast forward 5 years, there will probably be a few big Chinese companies that will be more global and major players. But right now, we're still in a situation, unfortunately, where people question a lot of the data. people question a lot of the information that comes from some of these companies. And it doesn't help that, now this is thankfully coffee, not something like a life-saving medicine, but I'm sure many of you saw the headlines about Luckin Coffee, which turned out to be a complete fraud. Though unfortunately, those sort of stories will plague nascent Chinese companies are trying to come onto the global market, because people still worry about whether these companies are trustworthy and the data is correct. And so I think that's unfortunately going to be a drag on many of them for, you know, the near to intermediate term. Long term, you know, there's innovation all over the world, and so I'd be bullish both long term, but I think in the near term, I still prefer the US and some of the European companies.
Monica, let me ask a quick question if I could.
Of
It's
course.
me that with corporate earnings, price earning ratios, things down considerably, question marks about the election, question marks about COVID. It seems the market is really hanging their investment on the hook of this is temporary, it will all bounce back in 2021. Because current metrics would say the market is way overpriced. And so you've mentioned that if there's some little glitches in Florida or Texas and there's some major economic activity, that could have a devastating effect on the market because it's fairly tentative because of all those things. And so some bad news. Are there other elements of bad news besides just COVID popping up that would that you think would cause the market to take a dive?
Yeah, I mean, I think we all need to be worried about anytime you're investing and looking at things like this, or the unknown unknowns, right? So we can talk about, it's unknown whether COVID will get worse in some of these southern states and we have another, you know, shutdown. That would certainly push out my view for recovery in early 21 to later 21. Will there ever be a vaccine, and a vaccine that they're able to actually administer and you know, manufacture at scale you would require to you know, vaccinate such a large population? Like, you know, people talking about this being out there by year end, like a lot of you guys are better experts in that world than me. I just find it very hard to believe that you actually have something manufactured, safe, and able to be administered in any meaningful way with earlier than the next year. And so, you know, those are certainly two big things. I did mention, you know, tax questions, and how does either the existing administration, if they win, or a new administration, if they come in, there will be pressure if there's a new administration to do something, to change something. So any big corporate tax change, I feel like that worries me. The last thing, and a lot of our earlier slides were focused on it, was the strength of the consumer. So anything that hurts the consumer is the most important thing to whether the US comes out of this recession or not. And so, you know, the biggest issues for the consumer would be if debt gets to a certain point where they can't service it, or rates become so high that they can't service it. So consumer balance sheets still have a ways to go before they get to that tipping point where we're about debt. But I guess another big shock, which again would be shocking if it happened, but if rates were to move up meaningfully. So the Fed decides we're going to start raising rates. I think it'd be crazy, it'd be suicide for the economy, but it could happen. That certainly would have a massive impact, because whether you're corporations, individuals, the US government, suddenly all that debt you have becomes much more difficult to service if rates are higher. So to me, that's, you know, a big question mark. One other point I do want to make to your point, Calvin, is, you know, I skipped over the valuation slides because part of the challenge of using historic multiples to value the equity market today is that the world we're living in is unlike any other historic period. And the real thing we're grappling with are very low rates around the world. We've never seen rates this low around the world. And so for me, as a, you know, someone who is focused on valuations, I would say, hey, the average historical valuation, the S&P, you know, 16 to 18 times in a, you know, a good period. Now we're looking at multiples 20 times plus. But again, with rates at zero, it's actually not crazy to think that valuations could hold at 20 times, even to your point, Kelvin, where you have all these tentative things going on in the US. Because again, the relative value of equities versus other asset classes, the fact that just by owning the S&P, you get a 2.5% dividend yield, which is a multiple of what you can get in fixed income, means that equities still just look relatively more attractive in spite of all the concerns we have, and in spite of how tentative everything feels right now. And so that, I think, is why the market is here. I would also add, we still have record amounts of cash on the sidelines. So this rally has happened while people and corporations are sitting on huge amounts of cash. So what if people start to feel a little bit more comfortable in the coming months? That means more money goes in, and that means it probably pushes us even higher. So I know it doesn't feel good because we're going outside of the band of historic ways we used to value markets, but I think you have to, because it is truly an unprecedented time from a rate perspective, especially, and that matters so significantly to equities.
Well, Monica, we really appreciate your time today. You have insights coming off the top of your head that most of us don't even think about. But your
I know we
insights are,
ran through a lot, so I'm happy. Any questions, follow-ups you guys have, please, you know where to find me.
there may be, and maybe a few will shoot your way. There's still a couple more that we didn't get to, but in the interest of your time and the people on the call, we want to make sure that we are respectful of that. And thank you so much to you and Brian for helping organize this and participate in it. It has been fascinating, as we expected. And a few people not able to join. Everybody wanted to know, was it being recorded? And I said, yes, it is. And so we'll have it available for those who would like to see it that weren't able to join today. And I assume you're okay if we share your slide deck. If not,
Of course.
we'll. All right, that sounds great. Well, everyone, thank you for being with us today. We appreciate it very much and hope you have a great week.
Great. Thanks, everyone.
Calvin.
Thanks.